disruption and no interruption. After he's done making his statement, we'll then come back to you for any necessary questions, clarifications, or anything of that nature. And at that point, you can ask whatever it is that you want to ask. It's open, but obviously within reason, and we'll try as much as we can to exhaust every question that you may have. But once you get to the question and answer point, I'll make just further announcements and rules. If anyone needs any record or anything, let us say to Manzali, so we don't disrupt when that statement is being made. Is there anyone who needs the record on the table? All right, I think that is it. Thank you very much, Governor. Please go.
Thank you. Good morning, colleagues. Good morning. Happy New Year to all of you. And I hope this is a year that will push us to greater strength. From strength to strength, we need to move. And today we will cover the standard presentation in terms of the discussion that took place yesterday, the Monetary Policy Committee. And after that, we will, as well as just told us, open it to Q&As. So in general, the inflation remains stable and within the range, our target range. And this is despite significant increases in the food prices. This went up by about 9% in December. And again, it's the standard products that we talked about last time: tomatoes, onions, and then of course maize and maize flour. All those obviously, or some of them are, at least the tomatoes, onions, and things like that, are being driven by the excess rain that we have been seeing. And we know what has been happening with the, maybe we don't know what has been happening in the maize sector. We know that is a significant sector. There are problems in that sector, as has been mentioned recently by the president, and obviously you are well acquainted with those things. Non-food, non-fuel inflation remains below 3%, low and stable. So inflation expectations are well anchored. As a matter of fact, the survey that we undertook, the MPC survey, the respondents flagged the continued rains and potential harvest losses as the concern. So exactly as I have mentioned in terms of tomatoes, onions, and other products like that. Global economic outlook. This is looking worse by the month. The IMF revised its forecast earlier actually a week ago, on Monday, on the 20th, and lowering their estimate of global growth in 2019 and also the forecast for 2020. Both were lowered by 0.1 percentage points, and therefore the growth estimate for 2019 is 2.9%, and in 2020, 3.3%. Frankly, this is the worst outcome, that is the outcome of 2019, the worst outcome in global growth since 2009. 2009, we had minus 0.1. And then before that, you have to go to 2001 to get 2.5%. So you can see things, no matter how you slice it, things are not looking great in the global economy. Now, there is obviously some positive sentiments that was injected into the economy earlier this month because of the conclusion, or should we call it the Phase 1 agreement between the United States and China. This is, if you will recall, was related to their trade war, or the disagreement that they were having on trade. And so they did get an agreement which was signed, and that was so-called the Phase 1. There are other things that still need to be dealt with. But that obviously injected a sense of optimism, because the sense before that was there may not be a conclusion. But be that as it may, there has also been significant downside risks that remain prominent. And this include, of course, the continuation of more trade wars between the US and China, the geopolitical tensions that we have seen, Iran and other places like that. Brexit has still yet to be resolved. Yes, there will be something later this month. So we are talking the end of this week. But still, there are significant uncertainties around it. And other factors, including even the stance of monetary policy in the advanced economies. All these mean that there's, or they have, they indicate, or they continue to show significant downside risks. On top of that, there's one other issue, which is the outbreak of the coronavirus in Wuhan, China. We all know what has happened there, and obviously there's a significant human cost to it, and the human life. But beyond that, there is the concern in terms of the economic impact of that. That's the containment, the measures to contain the virus. So basically, in one sentence, there are many uncertainties and also potential triggers to a significant, let's say, downturn in a rather fragile economy as we see it at the moment. As a matter of fact, just yesterday, in the advanced economies, and in particular the New York stock market, and indeed the New York markets, they actually, they took a hit. In a sense, there was a sense of a correction, mainly driven by the reaction to the corona virus, that the news about that, and actually that some people had been, or there were people in various cities in the US, that in particular Chicago, but other places as well, that had come down with this virus. So a lot of negative reaction in the markets to this. So that's the global economic outlook. Not good, but at this moment, a lot of risks. What about Kenya then? Kenya, the external sector. The external sector remains or continues to improve. The current account deficit is estimated in 2019 at 4.6% of GDP, which is lower than the 5% that was recorded in 2018. Now, if you look at the details of the balance of payments, what you see is that in 2019, it reveals that exports as a share of GDP, so if you measure things as a share relative to GDP, exports fell, but imports fell even more. So it's important to see that. Now we are talking obviously as shares of GDP. So in terms of exports, as a share of GDP fell by something like 0.8 percentage points, and imports fell by 1.7 percentage points of GDP, that is. Basically, that's how we ended up having a contraction in the deficit of the current account. I don't want to go into the details of exports and imports and so forth, but suffices to say on the export side, tea and horticulture have not been doing too well towards the end of the year. At the beginning of the year, they were doing well, but towards the end of 2019, they weren't so hot. Imports, on the other hand, have continued to contract, largely driven by the reduction in SGR-related imports with the completion of that project, at least the large imports related to that project. Remittances hit an all-time record. This is at, the number is let's just say 2,788 million. How is that? 2,788 million US dollars. That is the amount of remittances, our estimate of remittances in 2019. And this is actually about 50% of merchandise exports. I mean, by, far and away the largest sources of our inflows is now remittances. Now, I want to also mention that we have, the the current account deficit has been fully financed, FDI, and also portfolio investment. And I think it is important to mention that actually FDI has come back. There was if you look at, say, over the last 15 years, around 2007, there was a surge in FDI. And that surge related to specific projects that were being undertaken. For instance, the investments in the geothermal projects, windmill, and things like that. So there was a lot of inflow in FDI to deal with those large projects. And also, should we say, the oil exploration, a lot of large investments to deal with that. But then it has come down from that rather unusual level. It has come down in terms of percentage of GDP back to a level like 2% of GDP. And that's where we are. So we are around 2% of GDP, and that is partly financing the current account deficit, which we mentioned a moment ago, of 4.6% of GDP. I think that's the number I mentioned. So FDI continues to come. I think it is important to also talk about the diversity of FDI. It is quite diverse. And I think here is a case, there is actually an interesting story about where the FDI is coming from. By the way, if one thinks of all the trips that take place or all the conversations that maybe we have, yourselves included, with foreign investors, a lot of it will be coming as foreign direct investment for many reasons. But there is also the portfolio investment. This is investment, say, in our government securities, or for that matter, in a stock exchange and things like that. And that is also coming. What is interesting is that actually it's quite likely that you'll see a larger and larger proportion of diaspora ending up, investing in our securities, meaning it will be coming in, since they are, even though they have a Kenyan passport, their jurisdiction is outside this country. So that will be coming in as portfolio investment. And so don't be surprised with time to have not so much a decline in remittances, but a stabilization in remittances, but an increase in FDI that is related to people we know. Meaning, instead of them sending remittances, they will be putting investments in the government securities. It's a dynamic that we want to see this year, but it is something that already we can see. We can see it in nascent form. One other thing I wanted to mention about exports and trade is just to give you two numbers. This is with regard to the direction of trade. So the East African Community trade, this is exports to the rest of the East African Community, accounted for 23.4% in 2019. So you can see we are very local in that sense. And then we have, for Africa, the rest of Africa, I think this is sub-Saharan Africa, accounted for about 37.5%. So the point here is to stress the regional orientation of our trade. This is important going forward, particularly when you're talking of the African continental free trade area. This is important. And also you can see it has a stabilizing effect. The rest of the world may, if there are problems in the rest of the world, at least around us there is some stability. And therefore we won't have as much concern as if, for instance, we were 90% of our exports were going to a particular country or were going to the advanced economies or something like that. But I wanted to tell you that because in a sense it offers a sense of security because of the diversification that we have. Obviously it doesn't mean that we should rest on our laurels, of course not. But it is important to see where our risks are and maybe where our strengths also are. So, bottom line, foreign exchange market remains stable. I've talked about the contraction in current account, and the flows, they are very balanced. And we expect that this will remain stable in 2020, when we expect the deficit to be, the current account deficit to be around 4.7% of GDP. I think I have explained it a lot now, severally, that actually the current account deficit of around 5% of GDP is, I want to call it a sweet spot. It's more or less where you could say, yeah, that's a good place for us to be as Kenya. Okay, let's move on to other things. As you all know, in any of these things, we could talk virtually all day about any of these things, so it's better to move on. Banking sector, this remains resilient and stable. Liquidity risks continue to ease, and obviously there's better distribution of liquidity in the sector. Also, credit risk is easing. NPLs to loan ratio has fallen to 12% in December, from 12.3 in October and 12.6 in August last year. And almost half of this decline has been due to write-offs, or rather it has been 50-50, split between write-offs and also recoveries. So you can see there has been, let's say, there's been fruit, the banks have really gone on an aggressive campaign, aggressive recovery, right? And been working on that, and you can see it's bearing fruit in this regard. Now I'll talk later about, well, maybe I should mention also with regard to operational risks, this is something that we have been very much, let's say, aware of, and banks also, commercial banks have been alert, particularly now you're talking things like cybersecurity or other things. By the way, around December, that's when you have a surge in, in sort of cyber crime and things like that. For the same reason that you also have a surge in house burglary around that time. I'm sure this is your experience. I mean, because you travel, and so you leave home and people know you've gone and all that. So in the same way, the cyber crooks believe that this is an opportunity that they can exploit. Anyway, the banks obviously are wiser, and or they have wisened up, and we are not just talking Kenya, we are talking around the world. And so they too, just like yourself, that is when you set up your house alarms and whatever it is, and therefore you minimize that risk that would otherwise have been come to pass. We'll talk about other things in the sector, but I think it is important to mention that there's a lot of transformation that is taking place in the sector. And I think for those of us that, let's say, are impatient, then maybe this is not the job for them, because the transformation is not about a single iconic moment where you can say, yes, this is the mark that let's say, characterizes the transformation. There's a lot of hard work, a lot of grind. So, for instance, in the interest rate, post-interest rate regime, we've made the point that there has been significant transformation, and we've explained ourselves what is it that we are seeing and how we are dealing with it. And just to share darkness. So in the post-interest rate caps regime, obviously we have been working with banks even before, trying to explain to them and actually working with them to understand what still remains for them so as they can move to the next level, the transformation that we have talked about in our economy. By the way, we did write an op-ed piece that some of you published, but if you haven't seen it, it is on our website. And it is all about, why this time it's different. Why is it different this time? Meaning, why is it that we do not expect, after lifting of the caps, that banks will go back to the same old, Wild West sort of maneuvering? And I think even though I say it myself, I think we explain it well. What is it that we are saying? But what is clear is that we have been working with each of the banks, and we have been working in the context of the banking sector charter, and they have to come up with a plan. Indeed, even make presentations to us, but also have agreement and presentations to all levels of the bank, meaning including to their board. And the point is that, which is the issue I want to stress, we do not expect some sort of random, let's say, model, where they say, okay, this is for instance, how is it that they are going to assess that this individual has a certain risk profile? I mean, it cannot be a random number. It cannot be a random, let's say,